The final trading session of the week delivered a message Wall Street cannot ignore, even if it desperately wants to. This was not merely another rate close for the Dow or a forgettable Friday drift. It was a structural reminder that markets do not reward belief forever. Eventually, they demand proof. As the Dow Jones Industrial Average slid nearly 0.6%, and the S&P 500 stalled in place, and the Nasdaq Composite barely managed a cosmetic gain, the deeper story unfolded beneath the surface. This was not indecision, it was the market recalibrating power. The week itself had been unstable. Early sessions were shaken by geopolitical rhetoric after renewed tariff threats from the US President Donald Trump aimed at the European allies, a reminder that policy remains an accelerant for volatility even in an otherwise resilient macro environment. Yet, what made Friday decisive was not geopolitics, it was corporate reality. Markets can digest political noise; they do not forgive operational weaknesses, especially when valuations are stretched to historical extremes. That that weakness arrived in brutal form through Intel. The company shares collapsed as by roughly 17% in a single session after management guided revenue and profit expectations well below market estimates. The stated reason was difficulty in meeting demand for server chips used in artificial intelligence data centers. The unstated reality was far harsher. Intel failed the only test that matters in 2026: convert capital expenditure into dominance or be discarded. This was not a recreation to a single quarter, this was a verdict on a strategic credibility. For years, Intel has promised transformation, new fabs, new roadmaps, new ambition. Markets tolerated the delays because the artificial intelligence narrative lifted the entire semiconductor complex. But this tolerance has expired. AI is no longer a concept, it is an income statement line item. And Intel's inability to show competitive traction in the data center arms race exposed the widening gap between those who build the infrastructure of the future and those who merely talk about it. In a market entering what many investors now describe as a showtime phase, Intel was publicly categorized among the have-nots. This shift is critical. For most of the past few years, equity markets rewarded proximity to the AI story rather than proof of execution. Companies were valued on future relevance, not present cash flow. That regime entered. 2026 is shaping up as the year when artificial intelligence enthusiasm justifies itself in revenue growth, marginal expansion, and sustained demand. The tolerance for underperformance is gone. Capital is no longer patient, it is selective. The contrast was visible elsewhere in the semiconductor ecosystem. TSMC, the world's most important producer of advanced chips, recently delivered earnings that reinforce the central role in the AI supply chains. That performance had become the benchmark. Against it, Intel's miss was not just disappointing, it was disqualifying. Markets no longer are debating whether AI will shape the economy. They are deciding who gets to rule it. This environment sets the stage for what may be the most consequential earnings week of the quarter. The so-called Magnificent Seven are approaching judgment. Apple, Microsoft, Tesla, Meta Platforms, and Nvidia now carry the burden of validating some of the richest valuations in modern market history. On Friday, many of these names rose not because of new information but because of capital flow towards perceived certainty. That refuge is temporary. Once results are published, perception will be replaced by arithmetic. Nvidia's gains offered a revealing example of how fragile sentiment has become. The stock market moved higher after reports suggested Chinese authorities had signaled to Alibaba, Tencent, and ByteDance that they could prepare orders for Nvidia's H200 AI chips. This was not organic demand growth, it was geopolitical accommodation. Markets welcomed it anyway, underscoring how dependent prices remain on policy signals rather than pure fundamentals. That dependency is a vulnerability, not a strength. While investors fixated on technology, a quieter story continued to unfold elsewhere. The energy sector logged into another record closing high, extended its dominance as the best performing S&P sub-index of the year with gains exceeding 10%. This performance did not rely on narratives or speculative multiplies. It was driven by cash flow, disciplined capital allocation, and pricing power. In a market obsessed with future, energy is being rewarded for mastering the present. This divergence matters. It signals where capital migrates, where confidence becomes rational. Volume data reinforced the interpretation that Friday was not panic-driven. Trading activity remained close to recent averages, indicating that institutional investors were repositioning rather than fleeing. There was no capitulation, no euphoria, no sense of resolution. This was a market pausing to reassess hierarchy. In such moments, the most dangerous assumption is complacency. Sideways movement often precedes decisive trends. The broader economic backdrop remains supportive. Growth is steady, employment resilient, and the corporate earnings outside a few high-profile misses continue to hold up. But markets are forward-looking machines, and forward expectations have become less forgiving. With midterm elections approaching later in the year and geopolitical risks resurfacing, volatility is no longer a tail risk, it's a baseline condition. The essential takeaway for this week is stark. Equity markets have transitioned from belief-based pricing to evidence-based survival. In this regime, companies that fail to convert investments into measurable returns will be re-rated downward, often violently and without warning. Size offers no immunity, legacy offers no protection, only execution matters. This is not the beginning of a crash cycle, it's the start of a selection cycle. Capital is choosing sides. The strong will consolidate power, absorb market share, and justify their dominance. The weak will be quietly erased, not by headlines, but by valuation compression and relevance loss. Investors who fail to recognize this shift will continue to chase yesterday's story, and those who understand will position for tomorrow's winner. Wall Street has made its position clear. The era of excuses are over. The era of proof has begun.